Thank you for joining iMeet. When you hear the tone, you will be the 21st person to join the meeting. Meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And today we're going to quickly review the last couple of weeks since I wasn't here last week and see what's going on with the market. As if you've been reading the market letter, you know we're on a negative CTI count, but our market posture has been neutral for the last couple of weeks. So we're going to talk about how that can be and what's going on and what would make us go to a bearish stance on the market. This is your first time here. We usually talk about 20 or 25 minutes. We may be a little bit shorter than that this week, mainly because I have to catch a plane to go visit some clients in Texas. But anyway, we're going to open it up at the end for some questions. You can ask about different individual stocks, talk about some things that we maybe went over during the webinar, and then or some sectors, price targets, anything like that you want to talk about. We'll try to get to them. Let's go ahead and get started here. Okay, now we've already had about 4 weeks of a mixed market. We've had a negative or bearish CTI for the last, I guess, 3 weeks now. Neutral market posture. A lot of emails. What gives? How can we have that when we're supposed to be bearish in the market? We're going to go over that a little bit later on because the CTI is actually just one component of the market posture and our forecasting tool. And we'll get into that pretty soon. But we're also going to look today at some negative divergence that's showing up in the different technical indicators that may be pointing us towards a bearish stance, and also some support levels that we're going to keep our eye on. That if they are violated, we'll obviously flip over into the bearish stance here. Let me get the little arrow up here. Okay. Okay, last week we had our fourth straight week of a mixed market. This is the Dow Jones. You can see since the 1st of June, we've actually been trading in about a 2.3% range. Last week the market was actually all the major indexes were basically flat. Internal breadth was also mixed and flat. The NYSE and Nasdaq AD lines were, I think they might have been either up or down about 40 or 50 units, so they're not doing anything. Strength indexes, however, did deteriorate, and they are all in negative ground, which means that the broader number of stocks are lower. We're seeing some distribution. We're going to look at several charts of the different indexes today, and we just see if what we're going to try to do is see if we can get you to hold on to your money here if the market's going to roll over. We are looking at the negative divergence that's showing up in the indicators, and we want to see talk a little bit about what you should do when you see a market that's trading like what we have, and how to position yourself ahead of a break to the upside or the downside. Okay, if you've read the market the last 2 weeks, I mentioned Tom Ventresca, who used to work here, started in Market Eggs actually. He used to have a saying, he says, sometimes you're bullish, sometimes you're bearish, and sometimes you go fishing, which is basically what we've been saying for the last couple of weeks. And what you want to do when you have a tight range like this is you let the market tell you what it's going to do. You don't try to jump ahead of it. Now, what we're going to look at is some of the negative divergence that we see in some of the indicators, and maybe that is hinting at what the market's going to do, but you don't usually trade ahead of hints. You go ahead and you wait till either we start to break below this pivot point or take out some of the moving averages and have some other signs that we're going to go. So anyway, since the 1st of June, we've traded at the Dow about a 2.3% range. That's almost a crazy narrow range. Quiet trading, no volatility. A lot of that is the summer doldrums. However, you can see that the negative divergence is starting to show up. Here's the short-term MACD. It's bearish. That's usually the kind of what the short-term trend is. By that I mean like probably around a 30-day trend, which is basically you're just kind of working our way sideways to slightly down. We went bearish on the Friday on June 27th, and the Dow was at 21,394, and right now we're at 21,403. So the market's moved up about 10 points. The S&P 500 was 2438. It's actually down a little bit. The Nasdaq was at 6265, and it's down about it's down about 80, 90 points. So the market has traded mixed since that call. But again, when I look at all of the momentum index and the sentiment index, we've been borderline flipping to a bearish call. But again, until we get something that kicks off the signal, we're gonna stay neutral. All right, what you're looking at over here on this sideways motion, you're not going to see much. The pivot point on the Dow Jones currently is right in here at about 21,292, 21.3. We actually got down there just a couple of minutes ago when the market we were up earlier today. Then we were down about 110, just probably about 15, 20 minutes. Now it's bounced all the way back where the Dow's only down 6 points. So we'll go over why we're getting the swings now and why this week is kind of important. But what we want to take a look at here, you start to see a little bit of a breakdown to the 30-day stochastic. When we get down here around 50, that's even more bearish for this. You're having some negative divergence in the 14-day RSI. You're still staying above 40, and you're still positive on that, but not by much. Okay, now considering the season, here's the AD line on the NYSE, and you're starting to see a little bit more of a breakdown on this. I would say this isn't really telling us much. I would think if we get down here and lose about another 7,000 or 8,000 units, get down to this area, that would start to be more of a red flag. But with the pivot point at 21,292 on the Dow, that means that a trade below that level, which would be right around 21.3, somewhere in that area, like where we got down to today, bounced right off of that. That's going to probably set up a little bit of a test of the 50-day moving average, which is down here around 21,152. That is probably going to come into play here at some point this week. If we get down here and we break through that, then you've got this upward trend line that also coincides with the 100-day moving average at around almost close to 2950, somewhere right around that. So keep an eye on those numbers today. If you want to write those down or go back over this later, we'll look at that. As far as the S&P 500, you have a little bit more deterioration. The indicators look a little bit worse. You're starting to see that MACD signal line, still negative, almost crossover here. RSI momentum was negative until sometime yesterday. We rolled over a little bit today. You're probably below 50 on that. And you also have the 30-day stochastic, which I consider kind of an important trend indicator. It has actually started to turn negative on that. So that's something we want to watch. But you have this triangle pattern in here that you want to watch. Now, we're kind of bouncing up against that yesterday. It's around 24.27, somewhere in that area. We got down today to about 24, I think we're down right around 24.10, which is right where, on the market letter where I've been talking about, 24.05, which is right around where the trend line is, and right around, we're below the pivot point right now. But 24.05 to 24.10 is pretty good support. Now, if we break below that, we can get down here to the 100-day moving average, which comes into play at 23.90. A break below that, and I would think that we're probably going to go down a little bit further, maybe even go down here, test the the May lows, which is around 23.60. This negative divergence that you're seeing on this, actually, that's not really negative divergence when the market's pulling back, but you're seeing a little bit of a breakdown in these indicators, which is causing us to at least have raised our cash positions on that. Now you look at the Nasdaq, we already had a little bit of a pullback on that. We've got a trend line that came down. Sometimes we look at the sectors, when you break a longer term trend line and you come back up to it and you're bouncing back into it, that's a little bit of a problem. The Nasdaq needs to get back up to around above 6,200 and maybe 6,230 or so before it's going to start to be showing a little bit more improvement. You're probably going to get a little bit of a bounce. You're seeing a oversold bounce here, a little bit of a turn in the MACD, which could come up here, probably fail, and then roll over again. and you see the momentum is still a little bit negative on the Nasdaq, and we want to keep an eye on that. But like I said, I do think you probably could get a little bit of a bounce. Whether it's going to be today or not, we'll have to see, because there's a lot of stuff going on this week that could kind of end this little bounce that we've had. Here's the Nasdaq advanced decline line, a little bit worse shape. If we break through this area in here, and you can get this on the market at a glance on the Market Edge homepage, we see this breaking down to this range. That would probably give us more concern, a little bit more of a red flag that we want to watch. That it could induce some more selling. All right, next we want to look at is the Russell 2000. This is kind of a sick chart. This thing, the small caps, they're one of the biggest beneficiaries of tax cuts and a little bit of a stronger GDP. We got that initial bounce at the election, and since then we haven't done anything. We're going sideways. Kind of broke out to a little bit of a new high over here, a little bit of an overlap they call this, and now we're sitting here right on the pivot point, which is right around 1405, 1406. A break below that pivot point. Again, the pivot point stands for when aggressive traders are going to either be long or short. If we stay above this 1400 area, traders will buy the bounces and try to stay long. If we break below that area, which also coincides with the 50-day, and I think the 100-day also is right around 1390. But if you break below this 1400 on the Russell 2000, you're going to start to see more traders trying to short any bounce up to that. And even the indicators on the Russell 2000 are neutral. We can't get above that. Momentum is right at 50. That's about as neutral as you can get on that. But we are seeing a little bit of negative divergence in the 30-day stochastics, so the trend is not quite getting as strong as what we'd like to see. So we're going to kind of watch that 1400 level, maybe 1390 on the Russell 2000. If we start to get below that again, that could induce a little bit more selling. So keep an eye on those numbers with that. And also, I'm not calling for a 15-20% pullback by any means, but I do think if we can get down to here, maybe test the bottom of this range. That's the 200-day coming in here, and that just puts us at the bottom of the trading range on the Russell 2000, and that would probably represent about 5, 6, 7% pullback, which would be healthy for the broader market. Now here's the Dow Jones Transportation Index. Not a bad looking chart. We broke out of this downward trend, which we kind of followed here for weeks and weeks, hoping that this was going to help push the Dow to a new breakout. Never quite got that. Now we started to come over here, get a little bit of a Dow buy signal here with the Dow breaking out and the transports making a new high. But we're basically just a little bit over where we were back at March 1st. So it looks good, but we're not getting the big breakout. Now the histogram has a little bit of negative divergence on this. You may be getting a turn on this. Also, you're down today. Let me see what we're down. You're down about 70 points. You're down 0.75% on the Dow Jones Transports right now. So that's something we want to keep an eye on. Because that could start to give a little bit of a downward signal on some of these indicators, or maybe get a crossover here on our 30-day stochastic too. So keep an eye on that. The pivot point on this area is right around 94.50. We can come down to that area and not have any technical damage, but again, we're down 70 points. That would put us at around 95, right at 9,600. So that's right in here. We got a little bit more to the downside, where they're still going to stay bullish on the transports for a little while with that. But I do like the transports as long as we stay above this like 9,500. All right, so where does that leave us right now? With the negative CTI and neutral market position, a lot of you have sent me some emails wondering why, what's going to change this to a bearish. And as we've talked about the CTI and the market posture before, the momentum index and sentiment index are also components of that of the market posture. Now, currently, the momentum index is also neutral. We had a -1, then we had a -2. I keep putting the numbers in, and we're right on the line of going bearish. And what would cause that to go bearish is that the other indexes are are off of the highs that we made here recently in June on the different indexes, that they are trading, they're further off of their highs than what the Dow Jones is. You have the NYSE is right in line with it. That can flip a little bit, that can flip either way. The Russell 2000 is also right around in line with where the Dow Jones is. But you have had a pretty good pullback in some of the other indexes that are underperforming it, including the Nasdaq and the utilities and actually the S&P 500 is underperforming a little bit too. So theoretically, it's possible that if as the Dow pulls back here in line with the other indexes, you actually could stay neutral throughout a whole cycle where the CTI is negative. It's not likely to happen, but theoretically it could. So that's why we want to wait until like Friday at the close to see whether or not we want to move into some of the leveraged ETFs that we've traded here the last couple of years. We're basically on cash on that position right now, where we close it at 21,394. The sentiment index is also neutral, which isn't giving us any hints, and that's going to measure whether investors are a little bit more bullish, or too bearish, and it's neutral at this point. Some of those indicators are also mixed, and so it's until we see something actually change or a little bit further weakness in the broader market. As of when I punched the numbers in here about a half an hour ago, the sentiment or the momentum index was still neutral. So we're not going to front run that and say let's go ahead and buy up at half a position now and half a position later. I think it's better if you just wait till the Friday after the close and see what happens. Then you can kind of load up on Monday. Now I want to look at a couple more charts quickly to hold the key as to what we're looking at this week, because there's a lot going on. The first one here is light crude. You can see we've played a couple of these bounces on these calls. Again, you have the negative divergence going on, or not no negative divergence. This is just showing you that this is not a chart of strength. And we're seeing breakdown even in the accumulation distribution. You had a nice, pretty big sell on these couple of days here, and on that selling, you're getting an increase in volume, which is confirming that this is probably going to go down lower. Now, we had a call from with Goldman Sachs that they talked about. Of course, they've been wrong almost all year on commodities. However, they think that like we've been mentioning, probably around $42 or $43 a barrel is going to be the pivot point for oil. If we break below $42, I think that's probably the next do or die stop. That could lead to a retest of $40. Goldman is calling for below $40 a barrel. I don't know if we'll see that or not, but if we do, that's going to be negative for the whole broader market, and we'll go over that in just a couple of minutes. And one of the reasons this is light crude oil, and if you're not familiar why what the difference between light crude and what was going on with the fracking industry. With fracking allows the U.S. to produce light crude oil, which is kind of what you get over in Saudi Arabia and the Middle East. If you look at most of the oil that we've gotten out of Russia and Canada and the United States, it's that black sludge. The oil that we get out of the ground over in the Middle East, you can almost run your cars off that. They put them in your car and use that oil to go run for that. But with the fracking that we have right now, we produce light crude oil, and what they're doing is they're trying to mix that in with that black sludge, which brings down the cost of refining costs, and which can it's more profitable for the oil companies. So they're going to keep on producing this the light crude oil because it brings their costs down. However, at this stage, if oil does fall below $40, what's going to happen then is the reason that would start to bring down the overall market is because if you remember when oil was falling from $100 down to $30, one of the other components of the market was getting hammered was the banks. And if we go below $40, then you're going to you're going to start to see these oil companies not make the money that they were before. Now, right now, second quarter earnings for the S&P 500 are expected to come in line at around 8%. Well, a lot of that, or not a lot of it, but part of that is due to the oil companies, oil producers and all, reporting almost between 350 increase in earnings and 400%. Now, they clip that off of the S&P. Now you've got, instead of having 8% earnings, you're going to have about 5% earnings. So that would take a hit to the PE, and that's why you want to watch this oil, because that will affect, you'll start seeing earnings that get slashed going out towards the end of the second half. And it would also hurt the banks, because then they'll start saying, well, the oil companies aren't going to make their money, then we're going to get a little bit, that's going to hurt the bank loans too. So that's going to put some downward pressure on that. And that's, we're talking about some different things today, but that's something you want to watch. Now, another chart that we're going to keep an eye on, this is the UUP, it's the US dollar. And you can see we're in a downtrend on this. It's bearish. I think you'll probably get a little bit of a bounce. You're oversold enough here where you may get a little bit of a bounce, but this also isn't a chart of strength. You have a little bit of an oversold bounce in here. You're still above the pivot line. When we talk about intermarket analysis, what we want to look at that is what should be happening. And what should be happening when the dollar goes down, commodities should be going up in price. Okay, we're not seeing that. So when you see that the things in the market aren't working as they should, then you want to take a step back and get away from that trade. Now, if you just looked at this UUP chart right now and you were a trader, you'd be thinking about, okay, I want to go long the commodities. But then, but when it's not working, you have to know that, okay, what should be working isn't, so we want to step away from that trade. So keep an eye on that. So a long term on this thing, I think this is a longer term on the UUP. I don't think we'll see this. We're trading right now on 24.85. I think the bottom on this thing is probably going to be around 24.25. Then I think we can see that bounce around at that point. So I think a lot of the damage on the dollar is in right now, a little bit more to the downside. Then we'll have to start to see what happens. If we're going to get a little bit further strength on that. If not, because the dollar gets too strong, and that what would cause that would be a little bit more of a hawkish Fed. And we're going to talk about that briefly too before we close this out. But this week, the reason we're probably going to get a bounce in here, we have Yellen, the Fed chief. She's going to give her mid-year testimony before Congress, I believe, starting tomorrow. That can that could strengthen the dollar if she's a little bit too hawkish. But you have also several other central banks that are going to give some reports, mid-year reports too, and they're all thinking about raising rates at the same time. Now, Yellen, last time she spoke, she talked a little bit about valuations on the market. That was a red flag to the market. It kind of caused traders to sell in. What the Federal Reserve doesn't want to happen. They don't want to have some kind of bubble where as they're trying to raise rates, equities keep going up, and they're going, uh-oh, this can't, the raising of the rates should be, putting the brakes on equity prices, and that's what they would like to see happen. They don't want to see this market going up here and breaking out, another 5, 6, 7, 8% to the upside. Well, that's going to, just be further. Then we'll get in the bubble, will start to come down. So she wants to raise, she wants to keep this spike in inflation numbers from happening. She wants to make sure they're not behind the curve. If they get behind the curve and inflation starts to go, then they have to start talking about hiking 0.5% or a whole percent, and that's when you're going to see the market get hit with more than a 5 or 7%. They also she's going to need to talk about unwinding the balance sheet. She has like $1 trillion of extra cash she needs to get rid of that on the bonds. How aggressive she wants to get on that could affect the rates and also the market. You have the old phrase, you don't fight the Fed. And the Federal Reserve is determined that they want to get rates up here so they have some more ammo just in case for the next recession. And at some point, there's a place where when they raise it, all of a sudden bond investors are going to say, that's good enough. I don't have any risk in my bonds. I'll go ahead and take this yield, and I'll sell my stock positions. And that is when you start to see stocks sell off. So the last thing they want to see is stock prices continue to move higher while they're trying to tighten. And with that, I hope you got something out of that today to kind of look forward to. Because one last thing I want to mention, you also have the money center banks going to report on Friday with earnings season. If they report and you initially see maybe a little bit of a bounce, they report better than expected, and then you start to see the major center banks start to pull off, that would also be negative for the broader market. Estimates are pretty healthy for those banks, but keep an eye on that. I think Wells Fargo, JP Morgan report on Friday, and that also can kind of give us a hint as to what's going to go on long term. So if we don't get everything just perfect this week, we're probably going to slide over to a bearish stance on the market. The market's got to fight a lot of stuff this week, so keep an eye on it. I wouldn't be front running anything, but if we start to get a sell off, if we go to a bearish position, then I think you can probably buy those leveraged ETFs on Monday. Okay, go ahead and put your questions in. I see a couple coming in right now. What are the leveraged ETFs you have in mind? And also, Michael wants to look at the 10-year Treasury. Any opinion on that? Okay, here's the leveraged index ETFs. So if you've been around here for the last couple of years, we go long and short these triple leveraged ETFs based on the market posture. In 2016, had you done this, at one point we were up 70%. We were off in December. I think we ended up the year up about 58% on that by trading, going long and short on these ETFs. The ones that we're going to look at right now, and I suggest you get all four of them, because sometimes you may get a 5 or 6% move in the Dow, but the Russell 2000 you could get a 20% move in it just on the triple leverage thing. So I like to go all four of them when you're exposed to the whole market. These are the ones when we're expecting the market to go down. We have another set that we'll talk about when we get ready to flip over north. All right, Michael wants to know about the 10-year Treasury. I don't have the chart that I could pull up on this right now. I would look for the 10-year Treasury probably. We're at 236 right now. You've probably heard this before. It's not mine, but there is resistance where you're going to have some problems with the market, and that number comes in around 260. So I would look at that. If you start to see if the Fed gets a little bit too hawkish and you go over, you get up to around 265 on that, maybe even 27, you probably want to start getting into more of a cash position. I think that would be the prudent thing to do at that point. Have any more questions? So I have to cut out of here to get going to catch a plane, but if you have any questions about what we talked about, and remember, this week is pretty tough. We have a lot of stuff going on with the central bank and the Fed, and started some earnings with the big banks. You also have this test of crude. You did get a bounce today. You're back up here around 45.17. You're actually up 1.3 quarters on the crude oil. But we'll see if that can stand. It was due to go back up to the top of that channel. We'll see if it can roll over, because you've had some negative reports on it. We'll see what happens. But you can give us an email. My email is the doc@marketedge.com, and I'll try to get to you. I'll be back in the office on Friday. And again, kind of tune into this market letter on Friday to see if we're going to change our market posture to bearish, or whether we'll stay neutral again. And I hope you got something out of this today. I'm going to go ahead and take off, and a recording of this will be up on the website in about 2 hours. Have a good week, and I appreciate you taking time out of your busy day to join me in this. I hope you got something out of it.